Here is a scary reality for any business owner. A company can be highly profitable on paper, hit record sales, and still go bankrupt. This happens because the profit and loss statement we looked at earlier measures accounting profit. It records a sale the moment a deal is struck, even if the client hasn't actually paid yet. It simply measures promises, not liquid cash. To find out if a business actually has the money to pay its employees next week, you need the third and final financial document, the cash flow statement. This document strips away the accounting theories and early credit adjustments. It acts as the ultimate reality check, tracking only the physical movement of money hitting or leaving the bank account. Without physical cash, you cannot pay rent, suppliers, or staff. A system that only tracks on-paper profit is dangerously incomplete without this final reconciliation. This diagram breaks the cash flow statement down into three distinct processing categories: operating, investing, and financing. The first bucket is operating activities. This tracks the real cash generated from or used by your core daily business operations, like selling goods and buying inventory. The second category, investing, captures cash spent on long-term assets or equipment. The third, financing, tracks money moving in and out from bank loans or owner investments. Every single physical rupee that enters or exits a business must fall neatly into one of these three mechanical categories. Let's run a forensic trace on Sunrise Bakery. We start with the known output from Part 2, the 130,000 rupees on-paper profit from the P&L, which drops right into the top of our operating bucket. Now we make our first reality adjustment. The bakery had 100,000 rupees in credit sales from a catering client who hasn't paid yet. Since that revenue hasn't become physical cash, we subtract it out. Next, we add back 20,000 rupees for equipment depreciation. That was an on-paper expense that lowered our profit, but the money never actually left the bank. This settles our real cash from operations at 50,000 rupees. Moving down to the investing bucket, the bakery bought a new industrial oven this year. That means 80,000 rupees in real cash exited the business. Finally, the financing bucket. The owner took out a new top-up loan and paid off part of an older one, resulting in a net cash influx of 70,000 rupees. When we consolidate the changes from all three operational buckets, we reveal the total net cash change for the year, a positive 40,000 rupees. We add that positive net change to the 160,000 rupees the bakery started the year with. This results in a physical bank balance of 200,000 rupees. We have successfully tracked exactly where the missing profit went. Finding exactly 200,000 rupees validates the integrity of our trace and replaces accounting assumptions with mathematical reality. This geometric diagram maps the final closed-loop system. We have the P&L, the balance sheet, and the cash flow statement as distinct nodes, ready to connect. First, the P&L's net profit of 1,030,000 rupees routes directly into the balance sheet, increasing the owner's equity. Simultaneously, the cash flow statement uses that exact same P&L profit number as its starting point to calculate actual liquidity. And the final connection, the cash flow statement's ending balance of 2 million rupees routes back into the asset section of the balance sheet from Part 1, fully completing the circuit. The balance sheet acts as the final destination. The P&L explains how the equity portion changed over time, and the cash flow statement explains exactly how the liquid cash changed. Viewing any of these documents in isolation is useless. They are three different angles of the exact same mechanical entity, working in unison. When this integrated logic breaks down, you get the classic fast-growing startup failure. A company charts massive sales, looks invincible, and then suddenly collapses. Aggressive companies look fantastic on their P&L by booking massive amounts of credit sales, but they die from a cash flow crunch because the real money never arrives in time to pay the daily bills. This missing liquidity is the exact red flag banks, auditors, and savvy investors look for by checking all three statements together. A healthy business demands all three components: a strong net worth on the balance sheet, real profitability on the P&L, and positive, undeniable liquidity on the cash flow statement. True financial literacy requires looking past any single figure to understand how these three distinct lenses function as a single integrated system.